You talk about safe investments and don't know what IRA is. It's not an investment, you fucking moron. Unless if the price looks like this, okay? No, you motherfucker, okay? If customers had to close positions and they had to secure those positions using customer deposits, that means that
Coffeezilla, you need to let others speak and you need to respond to what I'm saying and not grandstand as much here. There was a big liquidity hole. That's what happened. If you want to judge that process.
How can there be a liquidity hole? And if there is a liquidity hole, why are you using a customer deposit to satisfy that liquidity hole when those customer funds were never meant to be used for margin accounts? This is fraud, what he's talking about right now. This is fraud.
I tricked Sam Bankman-Fried into a third interview with me, and this time he may have admitted to fraud. But I want to explain the background, the strategy that went into this call to try to learn where others had failed, including, by the way, learning from my own failures interviewing Sam. Since this was my third time basically doing the exact same trick, it was probably going to be one of my last, because at some point he was going to catch on. And because of that, I had to think long and hard about what the perfect line of questioning would be to really pin Sam down, knowing that he's a master at dodging questions. To this point, I didn't think anyone had gotten that smoking gun. He always denies everything. He always has a sort of a loophole out of it. So I'd have to try a different tactic. And here was my plan. Sam's whole excuse about not being a con man all hinges around Alameda Research. Basically, he says he knew nothing of what was going on there because he was just the CEO of FTX. And while that's nearly impossible to believe that he's this stupid or incompetent, it's really hard to prove 100%. So I realized if we were gonna do this, I'd have to remove Alameda from my case, right? I needed to show that Sam had knowingly defrauded people without invoking Alameda at any point. And here was my plan to do it. I was going to spend the entire time laser focused on the FTX terms of service. Now, some of you may know FTX lays out that they cannot use customer funds for anything. They can't trade with them, they can't loan them out. And I thought this was a really important point because obviously that money is no longer there. So clearly something must have happened. But I'm far from the first person to notice this. Many people, including my—
You're right. I think that smoke coming out of the mug is fake. Why would he fake that? Why would you do that to me?
myself have already tried to ask him about this and pin him down.
The terms of service for FTX, and I just want to read you this. It says, none of the digital assets in your account are the property of or shall or may be loaned to FTX Trading. FTX Trading does not represent or treat digital assets in users' accounts as—
Wait, is there a way to get an RGB code from a color in Paint? Can you do that? Edit colors. Oh. Holy shit. I should have been doing this the whole time.
belonging to FTX Trading. So how is it possible that Alameda had this loan of such a large size?
So there's that piece from the terms of service, but there were a number of other parts of the terms of service and a number of other parts of the platform on top of that. There is the borrow lending facility, where users were lending billions of dollars of assets to each other, collateralized by assets on the exchange. You had obviously futures contracts where there are leveraged positions on. Now, of course, all of this, it's meant to be the case that these are positions where FTX could, if it needed to, margin call those positions and close them down in time such that it would cover all of those, all those shorts, all those liabilities. Obviously, that wasn't the case here, and that's a massive failure of oversight of risk management and of diffusion of responsibility from myself running FTX.
But just make this very straight. Was there commingling of funds? That's what it appears like. It appears like there's been a genuine commingling of the funds that are of FTX customers that were not supposed to be commingled with your separate firm.
I ain't knowingly commingle funds.
Okay, Sorkin tried and failed here to pin him down on the terms of service. Why? Well, because Sam escapes in this talk about a different part of the terms of service, which related to margin trading, where you take out some kind of a loan. And in a way, it was a complete deflection. Like, it doesn't matter that there's a separate margin trading terms of service because the people who weren't margin trading still should have had their funds kept safe. But it sort of threw Sorkin off track. And so now we're going to move to the Stephanopoulos interview, which was a bit better because Sam's going to try the margin trading story. But watch Stephanopoulos. He does a better job at honing in on the question.
But as you know, the FTX terms of service tell the people who signed up, none of the digital assets in your account are the property of or shall be or may be loaned to FTX trading. But you're saying that happened.
My understanding is a few things happen. The first is there is a margin trading facility on FTX by which users can lend out funds, by which other users borrow funds. And so there are explicit cases where there is, margin extended, where there is borrow lending.
If Alameda is borrowing the money that belongs to FTX depositors, that's a bright red line, isn't it?
There are a lot of cases where that's actually explicitly part of the programs and that are happening.
But not here. Here it says that the digital assets may not be loaned to FTX trading. They can't be loaned out.
There existed a borrow lending facility on FTX, and I think that's probably covered. I don't remember exactly.
There's like 3 people that are even going to understand this, and I don't even know if I understand this. This is what it sounds like the problem is, and this is the trick that I think he's trying to play. Okay, I'm about to try to explain something that I probably don't even have a full understanding of. So my guess is that on this platform, there is the ability to trade on margin, right? You can borrow money to trade, okay? So you have the ability to do this, all right? When you're trading on margin, weird things can happen where say that the price of a security that you're trading gets really high or really low, your account might get margin called, meaning that your position is sold or closed, and then you end up losing money. You think it's kind of complicated, it's whatever. But like you have this side of the business that does this shit over here, right? But over here, you should have like customer funds that are deposited. And I don't know what else they offered, what other services they offered on this platform, but these funds are not part of this like weird leverage part of the platform. It's not part of like the margin trading or anything. So it seems like every time somebody tries to ask, how the fuck did your customer funds get fucked? And then he is, and then over here he's saying, well, we have a margin trading platform and sometimes weird things can happen when you're trading on margin, but it's like, that doesn't explain how these funds jumped this line. This is my understanding of why his explanations are never making sense. There's no explanation for how customer funds are being used to settle other accounts over here. This should never, ever, 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 ever happen. This should just never happen. So like in the whole Robinhood fiasco, where everybody said that Robinhood was corrupt and blah, 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 the Robinhood shit fiasco had to do with margin accounts being closed, basically, with people getting margin called because of how quickly trades were going. But never, ever, somebody correct me if I'm wrong, but never, ever were Robinhood users' customer funds at risk. That never happened, despite the wild fluctuations and collateral differences on GME and AAC and all the other meme stocks. There were never customer funds deposits that were fucking lost in the platform. So the customer funds jumping over here to being used to settle or close these margin accounts is just, he has never given a satisfactory explanation for how that happened. But he always tries to obfuscate or hide behind this weird, like, well, there were margin accounts, which doesn't actually explain what's going on. But I guess if you're not, I don't want to say if you're not super well versed in finance, you won't understand, because I don't know if I understand 100%, but like this should never, ever, 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 ever happen unless you're using customer funds to settle margin calls or to settle margin trading positions or whatever, like leverage positions. But I mean, obviously that's really fucking bad. Now, the reason why you would do that is because crypto is going up, 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 and it's like it's a sure bet, especially because of the weird deal they had where they were essentially playing arbitrage, which is typically pretty safe. But now the problem is that if shit crashes, not only are you left closing positions of customers, which is whatever, that happens, who cares, it's fine. But now you're using customer deposits to pay off those collateral calls, which is, that should be like federal prison. Like you're fucked. Like you're absolutely engaged in insanely illegal activity there, because you're basically stealing money from your customer deposits that should never be at risk in order to satisfy like either liquidity requirements or to close down positions that you had open. Like,
exactly where, but somewhere else in the terms of service.
But they'd have to approve of that. They're saying they didn't approve of it here. They're saying you approved of it.
Now, this is great stuff from Stephanopoulos. He refocused the question, but Sam's...
There's no motive here. Why would FTX do that? So they're not embezzling, just trading for no reason. They had no debt, no reason to do that. Well, the reason why you do that is because if it is the case that I have identified a certain type of trade that is very, 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 very safe, right? If I have a trade that's super safe, then my goal is to trade on that safe trade as much as possible. And if I can steal other people's money to do it, that's a surefire way to make money. Why would I not? I know the trade is safe. I can borrow all the money for my customer deposits. It's not at risk because I know I'm going to make it back because it's a safe trade. The more money I steal from customers, the higher my returns are going to be because that's what leveraging is, right? If I can trade for $10,000 or if I can borrow $10,000 and trade $20,000, make money off it and return the original $10,000, I've kept all the gains of trading with $20,000 while only risking $10,000 of my own funds, right? It's a no-brainer if you're a scam artist, right? So this is the reason, this was the incentive, I believe, for FTX or Alameda or whatever to steal funds from customers, is because they had access to these super, super, super safe trades that, and crypto was only going up, 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 that, yeah, basically like, oh, sure, like I can steal whatever I want to do this. Please consult a professional before giving hot takes. Danarchy, lol, if I said anything wrong, feel free to call me out, you inbred fucking moron. Knock yourself out. Why do platforms allow trading on margin? People like to trade on margin because if you're correct in your guesses, you can make a lot more money, right? Destiny has no clue what the fuck he's talking about. Well, if you think I'm wrong, feel free to correct me. Can you not just play retail with margins or only options? I'm pretty sure you can trade whatever the fuck you want on margin. If you go to an account, if you go to any trader and they let you open a margin account, I think you can buy whatever you want. You can probably trade stock on margins. You can probably do options on margin. Probably whatever the fuck you want on margin. If they approve you for the loan, they charge you interest. You pay that shit all the same, right? Well, let me qualify that a little more. You wouldn't be able to just trade anything on margin. I don't want to get into all of this because it's going to be complicated, but depending on the type of security that you're trading, or depending on the type of financial instrument you're trading, we should say that, there's going to be different liquidity requirements on your margin account. Typically, the more volatile, meaning the more subject to change of price in a day that a certain security is, the higher that volatility, oftentimes the higher the liquidity or collateral requirements are going to be on the particular margin. So there's probably some financial instruments that are too volatile to be traded on margin because the platform won't let you do it, but that's a whole other thing that no one cares about. I think the fraud specifically is that there were specific funds where the TOS said they wouldn't trade on your funds, but they did it anyway. Yeah, kind of, but I'm just saying that, like, if you don't understand the financial minutia, it's hard to catch him in the game that he's playing. But people are saying he does. Coffeezilla does in this video, so we'll watch. But the answers that this guy gives are always so slimy, they make no sense. And it's not like but he's good at weaseling out because nobody really knows what's happening, right? Like, yeah. Like, let's say that I've got like 2 financial services that I offer. Let's say that I'll lend you a little bit of money. Like, you can deposit $10 in my account, and I'll lend you $10 to let you trade on margin. Let's say that that's like one service that I offer. So you can deposit money with me, and I'll lend you a little bit more to trade if you want, but you got to pay interest rates and shit, and that's all. And then let's say on another side, I'm like a savings account. You can deposit money with me, and I'll hold it and I'll pay it back. Let's say that one day there's a huge run on the market or some crazy shit happens, and now all of the people that were trading on margin, now I'm like, okay, I have to close all of your guys' accounts. I'm returning your original funds, whatever. That's okay. That happens. That's fine. But now let's say all the people that deposited money into my services for savings accounts, they lost their money too. Well, their question is going to be, hold the fuck on. Why the fuck did my money just disappear? How the fuck did I lose money how did I lose money? And the guy goes, well, you see, it's complicated. There's a section of our website that allows for trading margin. Like, whoa, hold on. I wasn't involved in any of that. I just want my deposits. Like, I wasn't trading. I wasn't doing any of that shit, right? That's the issue, is that he keeps referring to this other part of the business of like margin trading or whatever that has nothing to do with the original deposits of the customers. Those should never, ever, 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 ever be at risk. They should just never, ever be at risk. That should never happen. It shouldn't happen. Unless you're using customer deposits that should be safe as the collateral for the margin accounts, which is only going to work if the market goes up, up, up. But then if the market goes down and you've got to shore up those positions and you start stealing from your customer deposit to do so, but that intermingling, you've done something very, very, very wrong at that point. That's the issue, right? I think, but okay. But we'll see what happens to this. Or at least that's my understanding of what's happened so far. For real, that's my understanding. Were they not even collateralized? Were they naked? But no, they weren't naked. I don't think anything was naked. I think they were covered with customer deposits. I think that's the issue. But okay, let's see.
About to weasel out with the new trick. Go ahead and watch.
If you rewind to the beginning of FTX, where some customers were I think in line with sort of existing relationships that they've had, at least in some cases, wiring money straight to Alameda Research in order to trade on FTX.
So you do know, and you did know, that FTX deposits were being funneled to Alameda.
So I was vaguely aware that that was how some wires were being sent in the first place.
Didn't that set off alarm bells in your head?
So there were a lot of people who were involved in that process. And look, I really deeply wish that I had taken a lot more responsibility for understanding what the details were of what was going on there.
This is how he slips out again. He tried the margin trading explanation. It didn't work. So he pivots to, okay, well, there's this weird backstory where FTX used to take wires from Alameda. And maybe that's where we lost the money, right? It's another smokescreen, but unfortunately, it kind of hamstrung the conversation. And if I was going to succeed, I'd have to beat that explanation. And in the first couple interviews I did with Sam, I tried to go with this insider angle, where insiders I had talked to had told me something very different, but it didn't work. Go ahead and watch.
There's sort of all this talk about the terms of service. Did you break terms of service? Did you not? You're basically claiming that there was this separate side of your terms of service. But I talked to somebody from Alameda and asked how big the position of or how many people had assets in the type of accounts that terms of service would apply to versus the regular terms of service, which said you couldn't use their money. And they said it was about $1 billion that was in the margin trading or the margin side of things where you could reuse their funds or whatever, and the rest of it was not there. So it seems like you're putting all your eggs behind this one excuse about, there was this separate side of the terms of service. How do you address everyone else?
So I don't have all the data in front of me. My memory is that it was substantially more than $1 billion. I can't verify that.
The music, dude.
On top of that, there were other effects as well. Some of those were early wire transfers sent directly to Alameda.
Yeah, I kind of got stuck where Stephanopoulos roughly got stuck. I should have known that he was just going to refuse the evidence of insiders and just say, well, I disagree.
Wait, okay, I don't, this is my last interruption. I feel like this is the only question that needs to be asked. How did customer deposits get used to settle margin accounts? Why were customer deposits ever used for collateral? I feel like that is the simple question that cuts through all the bullshit. How did it ever happen that customer deposits were used to settle margin accounts or settle collateral requirements? That's the only question I feel like you put.
And go back to his Alameda wire explanation. And I tried following it up a bit, but it didn't really matter. I had kind of missed my shot on that particular angle. And as I reflected on this, I realized all of the talk about margin trading, future trading, wire transfers to Alameda, all of it is a smokescreen from the big problem. The big problem is that some percentage of FTX's customer base never sent a wire to Alameda. They never signed up to margin trading. They never did spot margin.
Yes.
All they did was put their assets on the platform.
Yes.
And they were told
yes.
that their assets would not be borrowed.
Yes.
It would not be loaned out. And that money would always be there.
Yeah. Okay. Thank you. Thank you, God. How has nobody hit this point yet? It's because I don't know who they need to get an actual financial reporter to ask these questions. Because it sounds like none of the other people knew they were doing. Yes, that's the question. That's it. Thank you.
And it wasn't there. Why wasn't it there? There's no other way to explain that. If the money's not there, then fraud. And I had to laser in on that one point, not get distracted by these shiny objects that Sam's throwing up about this or that, or what about this, what about that? No, there's only one question that matters, and it's impossible for him to answer, I thought. So that was my strategy going into it. That was the backstory and how I learned from previous interviews. So without further ado, here's my third and probably final call with Sam Bankman-Fried.
If you're trying to do things with good intentions.
I'm about to go up.
Okay, Coffee, you're up.
Hey, Sam, it's me again. I just wanted to ask real quick about the terms of service question, which Rect brought up a little bit. I want to expound on it. Can you just tell us, yes or no, were you treating client assets just on the regular digital asset side different from the margin trading side?
I do think we're treating them differently. There were a bunch of different sides, or more than two sides there, but I do think that we were cognizant of the fact that like there were differences between uses for like margin versus staking versus spot versus futures collateral versus other things.
Yeah, just people. I'm just talking about people just putting Bitcoin on the exchange.
Yeah.
Obviously, there was really clear terms of service around that. If it's true that you didn't invest client assets, not even in treasuries, as you said via a now deleted tweet, why do those client assets no longer exist?
Yes.
So I'm trying to trace through some of this. Here's my best guess, and I wish I could give you a more confident answer, but I don't have the data. But my best guess is basically it's a combination of the following. One piece is the transfer sent directly to Alameda Research from customers.
Is he talking about funds just deposited on FTX? Why would those ever go to that Alameda Research shit? Am I wrong? I don't understand. That was
one piece, and that I think is a fairly substantial piece. One piece is...
Wait, can you explain what that piece means? So people were sending money to Alameda instead of, they were getting credited on FTX, and Alameda just ended up using those funds.
Yes,
and they were never held separately per the terms of service.
Well, there was a separate legal agreement with that. I don't know the details of it. I don't have it in front of me.
Fuck the legal agreement. Just explain
the legal agreement with respect to transfers that were sent directly to Alameda Research by users, especially before FTX
That's not the question.
Had its own bank accounts. And so I do think that is part of what happened there, likely.
Let's focus on
that. So what he's describing is like what? Like customers are sending their money to places that they didn't know about? Because that's what he's describing now is like a scam. That just sounds like a scam. My money is going to places that I'm not aware of. It sounds like a scam to me. Why the fuck is my money being sent to some people that I don't know anything about? Why the fuck is my train not working? There we go.
Only client assets that happened after FTX got a bank, y'all said digital assets are treated a very specific way. Why were those digital assets not treated that way?
So of the remaining piece, and there's a few other pieces as well around futures and other things. I understand that's not what you're talking about. For the ones that you are talking about, right? For the ones that were left, and I'm just taking a stab at this because I don't have the data, but my best guess is the following, is that there were a lot of those assets remaining. We processed something like, $5 or $6 billion, I think, of withdrawals over the few days prior to, or I guess the few days, during the crash. And there are still a few $1 billion of those remaining, I think, in the estate. And so you put those together, you have many billions of dollars of those assets. But I think, and so that's part of the answer, is that there were a large number of actual assets there. I think there's one follow-up question you probably still have there, which is, well, how about people who didn't withdraw and were also in that bucket? And part of the answer is, well, there still do exist some number of billions of dollars of assets
of hard assets in the estate.
No, is there one-to-one assets? Because that's the whole thing. We're talking about a separation of funds. So those funds should be a completely different, in a different place, in a different wallet than everybody else. What you talked about servicing billions of dollars of withdrawals has nothing to do with those specific.
Why the fuck is this guy giving interviews to people at all? Why the fuck is he talking about this publicly? It feels like it can only hurt him.
Digital assets, because that's just first come, first serve, whoever pulled out first. We're talking about people who never agreed to have their funds loaned out, who never agreed to have their funds put on margin. They should have, according to your terms of service,
everything,
one-to-one backing.
Yep.
It should all still be in some bucket somewhere. And are you confident today, as the CEO of FTX, this has nothing to do with Alameda, are you confident today to say that those are absolutely real and they exist and they're present, people are backed one-to-one on client digital assets?
So I think, and again, I'm just taking a stab here, but I think what happened is that if you look at especially a lot of the withdrawals that happened, those withdrawals were not necessarily only coming from people who never used margin trading or futures or staking or anything else. Those weren't just withdrawals from people who were keeping one-to-one backed. Or we're sort of just keeping them as pure spot balances, and it was omnibus wallets between the various categories, and so I think that the answer to your question is that a number of those assets were withdrawn by people who had balances on the exchange, potentially in the few days prior to the collapse, and if you wanted to think about it this way. It could be that that happened, and then when the collapse sort of completed, that effectively meant that there was, if you wanted to put it this way, like fungibility created during those withdrawals between assets for people who had and had not been using.
But that means that there is no separation of funds. If there's fungibility between two different buckets of there are no buckets. It's just one bucket.
Did he really say fungibility? I have to listen to this again. This guy's answers are so convoluted. Hold on.
Completed this way, it could be that that happened, and then when the collapse sort of completed, that effectively meant that there was, if you wanted to put it this way, like fungibility created during those withdrawals between assets for people who had and had not been using.
But that means that there is no separation of funds. If there's fungibility.
I think when somebody says fungibility, I don't know specifically in the world of finance, but I think fungibility means that like it could come from one account or it could come from another. Like if you've got like two checking accounts, there might be some fungibility between the two, because if you withdraw money from one, you can just move money over from one to the other. That would be like fungible money, right?
Ability between two different buckets of there are no buckets. It's just one bucket. Everyone's taking out of the bucket, which means substantially anyone who had your terms of service with digital assets wasn't actually subject to that terms of service. They were subject to the same terms of service of your margin trading, right? Which is your more risky product. So you subjected everyone to the higher risk product because fundamentally, when it came down to it, you're saying there's fungibility. It's $1 here, $1 there. Everyone can take out $1 as fast as they want. Don't you see that as like defrauding your customers, the people who trusted you to just say, hey, this is not going to go anywhere except for we're not investing your assets? If I can exchange one-to-one and I'm the one who put risky stuff on with risky assets with risky terms of service.
I'm sorry, but you're a finance midwit. Everything is Reddit tier analysis. Tell me one thing I've said that's wrong. Stock awfully hot. What is wrong with this guy? Destiny. Again, 0 people in the finance world have ever called any crypto holding safe. It's one thing to buy gold, another to speculate in a highly volatile crypto market. Nothing you're saying makes sense. 0 people in the finance world ever called any crypto holding safe. Sure, but at the very least, your crypto should be safe. Actually, I don't even know if I agree with you. Mt. Gox is going through like a massive like settlement process, paying out like people, not to mention all the people that are starting to go to jail and everything because of these types of scams. Hold on. Anybody else that needs to get a... Okay. For exactly these types of scams. I don't think you can just have people deposit money in your thing and then steal it and say, oh, well, it's not safe, it's highly volatile. That doesn't make any sense. The volatility is actually totally irrelevant here. Like a Bitcoin is not volatile to a Bitcoin. If I give you 1 Bitcoin, I should be able to get back 1 Bitcoin, right? It might be volatile in terms of exchange with other assets or other currency, but Dessing and 0 people finance whatever crypto holding safe. It's one thing to buy gold, and I don't know what you're talking about. Like, gold can be volatile as well, so can silver, but if I buy 1 bar of gold, I should still get 1 bar of gold back. It's hard to believe that he would do Twitter spaces like this if he was guilty. Yeah, like when Shkreli came onto my stream like 5 years ago and basically admitted to securities fraud or whatever, and then got like federal prison exactly for the same thing he admitted on my stream. No wrongdoing from FTX, such as poor company internal controls overall. Nothing was illegal. I don't think you have... I think, are you just a writer of this guy? Or are you this guy? Client funds were mixed up unintentionally. If it was intentional, it was almost certainly from SBF himself. How do you mix these funds up, my dude? You're running an exchange... I'm sorry, but like the mistakes that you're talking about sound like mistakes that you would expect from like a fucking rando duder, not a guy managing... What? You said FTX is a $100 billion company? Like, bro, the fuck are you talking about? Tell him to come on stream? If he wants to come on stream, he can do it, sure. Hopefully, I'm sorry, but your finance midwit, everything you're saying is return. Explain what an internal rate of return is right now. I don't know what an internal rate of return is. Does that mean I automatically lose the discussion? The internal rate of return is a metric used in financial analysis to estimate the profitability of potential investments. IRR is a discount rate that makes the net present value of all cash flows equal to 0 in a discounted cash flow analysis. IRR calculations on the same form as MBV does. Okay. Oh, well, if you want to hop on Discord and chat, buddy, let me know.
I can take the money that someone who didn't sign up to those same risky terms didn't agree to. Isn't that fraud?
So I'm specifically talking about what happened in the... Do
you want to hop on Discord, my dude? Why do you think, you know, anything about finance? If I've said anything wrong, feel free to like call me out. But I mean, like, if you just want to, if you just want to like throw esoteric finance terms at me, and then ask me if I know what they are, like, there's probably a whole bunch of shit in finance that I don't know. This is Finance 101. I never took Finance 101. I'm a wiki warrior. But if I'm incorrect on something, feel free to call me out. Or feel free to hop on Discord and we can chat about it. Just checking this. Assuming you were talking about crypto, the difference with gold is that it is inherently less volatile because existing physical atoms limit its abundance. I don't know. I can't tell what you guys are talking about right now. It doesn't matter. The volatility is not relevant here. This could be the most volatile substance in the world, but it doesn't matter. If you put one in, you should get one out if you're not risking your funds. It doesn't matter how volatile it is. It's not esoteric, idiot. It's about how people evaluate investments. You talk about safe investments and don't know what IRA is. It's not an investment, you fucking moron. These people weren't investing their funds. They were depositing them. A deposit is not an investment that is subject to loss. If I deposit $1 in a fucking bank, I should be able to withdraw $1 from a fucking bank. I'm not investing it. I'm depositing it. It's a deposit. It's a holding. It's not an investment. It sounds like the people on FTX were depositing money that was separate from the investment part of the platform. They didn't lose their money because they made a bad investment. They lost their money because FTX stole their deposits to shore up their investments.
Days immediately during and following the crash, in that, you know,
this guy's trolling me. Hold on, I know he is. Okay.
Or say so day period, and during that period, I think we may have allowed, just generalized withdrawals. I think that was, if you're saying that we should have held up withdrawals for everyone who had an open futures position, for clawback potential or something like that, I don't know, maybe that would have been the right thing to do. I hear where you're coming from on.
Would you say the same about U235? If you put them in a bank for long enough, it won't be U235 anymore. That's what SBF is explaining in crypto terms. Oh, what? That's gotta be a troll. That's gotta be a troll. We're not depositing unstable radioactive isotopes into bank accounts. That has to be a troll message.
That, I felt, at the time, that, we wanted to treat customers equally. It was an incredible.
But they had agreed to different things, so you can't treat them equally. I mean, it's like, this is the whole problem of the story of FTX and Alameda.
Treat customers equally. What the fuck is this guy talking about?
Is all the funds were being commingled. Isn't this just another story of commingling funds, except this is now FTX, which you can't pass the blame to Alameda anymore.
Also, don't just talk about the commingling of funds that lost customer funds. That's only half the story. These commingled funds have been used for however long FTX has been running to make them more money. So not only are these commingled funds shitty because customers lost their money, these commingled funds are shitty because they were being used to enrich the owners of the site, right? They're making money off of gambling with this money too. It's the other half of the scam.
Or this is your company, your funds that you are treating all the...
The reason they keep talking about volatility is because you use the word safe when talking about crypto, but they try to understand you weren't talking about whether it's safe investing, you're talking about whether the group of cash should be... Here's an example. Let's say there's a stock, okay? Let's say there's a stock, and let's say the price looks like this, okay? Whoa! Let's say that's what it looks like. Let's say this is a stock graph, okay? If I buy one share of this stock, and it's being held somewhere, okay? I should be able to sell that one share of that stock. Regardless of where the price goes, I have one of that stock. Even if it's highly volatile, I should still have one of that stock. Doesn't matter how volatile it is, I still have one of that thing. If Bitcoin looks the same way, sure, Bitcoin might be highly volatile, I should still have that Bitcoin though when I go to withdraw it. Volatility doesn't matter here. It's not relevant.
So
that may not actually be accurate. What he's saying is that they use commingled accounts to allow traders on their platform to cash out. It doesn't necessarily mean the FTX was investing in deposits. It just means that they use customer deposits to exit customers. No, you motherfucker, okay? If customers had to close positions and they had to secure those positions using customer deposits, that means that they were not maintaining the correct amount of collateral in order to have enough equity in those accounts to satisfy the collateral requirements if they were closed. That means the only way that those accounts could remain open and profitable for the company is if they were securing those accounts with collateral from deposits that never should have been at risk. If you ever have to use customer funds to secure a collateral requirement or close or shore up an account or position from another person's account that you're making money off of, you are making money off of customer funds that should never be at risk by risking them. I don't care. Never mind. I don't care. You either get it or you don't. You either get it or you don't. You either get it or you don't. I don't care. Don't care. I don't care. I just want to finish listening to this and I'm going to go pick up Melina from the airport and we're good, okay? Okay.
Respond to that, and please, I completely respect your question, but you have monopolized all of these discussions, Coffeezilla.
Ooh.
You need to let others speak, and you need to respond to what I'm saying and not grandstand as much here. I completely understand where you're coming from, but to answer your question, I didn't make a decision there. We processed withdrawals as we normally do until it became clear we couldn't anymore, at which point we shut them off. And it was the case that, like, at that point, there was a big liquidity hole. That's what happened. If you want to judge that process.
How can there be a liquidity hole? And if there is a liquidity hole, why are you using a customer deposit to satisfy that liquidity hole when those customer funds were never meant to be used for margin accounts? This is fraud, what he's talking about right now. This is fraud. I have a liquidity issue and I'm gonna satisfy it with customer holdings, with customer cash deposits. I'm gonna satisfy my, that's insane. That's fraud. Full stop. That's fraud. Full stop. The only way they were able to maintain those accounts is by satisfying the collateral requirements with accounts that never should have been at risk. And if you're using those accounts to satisfy collateral requirements, by definition, they are at risk. That's fraud. That's fraud.
And think that, like, we should have been spending those days frantically trying to code up a new withdrawal process. I disagree with you, but I understand where you're coming from.
Yeah, sure. I think that's fine. I mean, it's not about coding up a new withdrawal process. It's about treating your client assets the way you told them they'd be treated, right? It's a very different thing completely. But anyways, I'll stop grandstanding for Sam. Thanks, guys. Oh my gosh. Woo! Oh my gosh. Wow.
Wait, what's
we got the
happening
call
here?
out. We got the shout out. All right. You can probably tell I was pretty excited about that because I finally got what I was looking for. A straight answer on the problem of funds, right? Sam explicitly says that FTX was not separating funds. They were allowing generalized withdrawals. The dollars were fungible from different buckets. You can't do that. We finally dodged all the BS about margin trading, about Alameda wires. We finally got to the heart of it, which is that there are no funds left over for the people who just should have had their funds separated because they never separated them from the beginning. They were always seemingly commingled. And although Sam wouldn't necessarily agree that they were always commingled, the proof is in the pudding. To give you kind of a regular finance analogy about why this is so cataclysmically bad, and in my opinion, fraud, imagine you banked at JP Chase, right? And you have your money in the savings account part. Well, then you find out that they actually had this risky hedge fund. And you know what? They actually kind of blew up. In fact, they blew up so badly that JP Chase, it's all shutting down. But when you go to the bank to withdraw your money, you find out that instead of keeping your money safely in your savings account, they had allowed the people in the hedge fund business to just withdraw it, you know, first come, first serve, right? They treated all clients the same, according to them. Well, you say, well, no, that's fraud because you signed up to very different terms of service than the guy who knew he was going to be like, you know, in this hedge fund, right? He had a different level of risk. He acknowledged that level of risk. And if you just throw all the money in one pot, the terms of service are
you only have one pipe coming out of the chemical plant. You need 4. Wait, what pipe where? What? The water. Right there, the slow pipe that penetrates the shield from the chemical plants. What are chemical plants? I have heat exchangers, I've got condenser turbines. Are you talking about these pipes here? These metal pipes? You mean the nuclear reactor? The thing you're offloading the ice into. Oh, this shouldn't matter. This is, I only use this over here to make sure that these water tanks stay full enough to be functioning. I'm trying to bump these from 5K to 15K because I think I don't have enough water pressure here. I don't understand how I'm not getting enough steam in here. Sorry.
Meaningless, right? You're exposed to the same level of risk as the guy who took on huge risk. And that's fundamentally what happened at FTX. That's fraud. They told people their money was safe, and ultimately, they just subjected everyone to the same risk as like the day trading degenerate gambler on 100x leverage. And I really found the last thing Sam told me like so telling.
To answer your question, I didn't make a decision there. We processed withdrawals as we normally do. That's what happened. If you want to judge that process and think that like we should have been spending those days frantically trying to code up a new withdrawal process, I disagree with you, but I understand where you're coming from.
This is so interesting because no, of course I don't think you should be coding up a new withdrawal process while you're going bankrupt. But if throwing all your client funds in a pool and letting the first come, first serve get the money, that's the wrong process to begin with. Your process was fraudulent from the start. It should have never been your process. Your process should have been what you promised clients, which is, of course, what I told Sam. And although I think Sam's probably guilty of a lot more than we covered here, I really wanted to get to this minimum viable fraud case, and I think we did get it. I mean, there is no sort of wiggling around the fact that he was the CEO of FTX, and all of this stuff that was bad that we proved happened at FTX. You don't have to invoke Alameda to get to this. So you can't say he didn't know, because he definitely did know, and he says he knew. So the last thing I'm going to close on, and I thought it was the funniest part, was his little outburst at the end about me monopolizing his time.
So I just want to respond to that, and please, I completely respect your question.
LeMayo, Dusty just wants to silence because he fears. What? Get rolled by the question if they have paid $10. Oh, you're asking a stupid trivia question. Never mind.
But you have monopolized all of these discussions, Coffeezilla. You need to let others speak, and you need to respond to what I'm saying and not grandstand as much here.
And I thought it was notable for two reasons. One, he hasn't lost his cool once in any interview. This is the first time I heard him like really crack. And I thought that was interesting, but I also thought it was interesting because it's just not true. It's totally wrong. I've talked to Sam for, I think, 30 minutes across 3 interviews total, like in total. And for context, he gave the New York Times an hour. He gave George Stephanopoulos 2 hours. I think out of everyone he's talked to, or at least of the major interviews, I've talked to him the least. So if anything, I'm efficient with my time. That's all I'm gonna say. And speaking of being efficient with my time, this video is over. Lock this man up, and I'll see you later. Thanks for watching.
Deyama, ha ha. Deyama. Let me dumb it down for you. FTX invests profits, not deposits. Nothing wrong with that. Customer funds are mixed with profit. Crypto speculation made, but there was no safe crypto investment. You just don't understand what you're talking about, but that's okay. I don't care. I don't care to talk to you. Think what you want. You can... Oh, fuck me. You can invest customer deposits without investing customer deposits. You can risk customer deposits without investing customer deposits, okay? Let me help you, okay? Let's say that I have $100,000. Okay, also hold on. You keep saying you're informed by Reddit and Gorillazilla. The Reddit position on finance is that GME was a global scam and that those shit, why the fuck you, like, Reddit finance is super stunk. So I don't know why the fuck you're like roping me in with those fucking morons. They're more likely to agree with you than anything else, okay? So let's say you have $100,000 in customer deposits, okay? Let's say that on the other hand, let's say that you have $100,000 in customer deposits with like oh fuck, how would we even, this is gonna break my brain trying to do this math. Let's say that you have $100,000 on your end of the site that you're using. Wait, you can't do that. For some type of investment activity, okay? And this investment activity involves trading on margin, okay? Let's say that we use a $200,000 margin, okay? Meaning we get $200,000 of money to gamble with. So we're able to take our $100,000 and we invest $300,000, right? But let's say that in order to actually gamble with this much, in order to satisfy these collateral requirements, we have to use money from elsewhere to secure it in case we have to like close this position. If we use our funds over here to do that, then what we're doing is we're trading over here on leverage or on margin, right? We're using leverage, we're trading on margin. We're not technically trading with that customer money, but the only reason we're empowered to make these trades over here on margin is because if these accounts get fucked, if they go too far up or too far down, and we have to satisfy a collateral call or a margin call, then we use the money over here to do it. That's the problem, right? You can't, even though you're not technically investing this money, you're using this money to secure these investments. And that sounds exactly like what happened. What were the deposits for originally? I don't know. It sounds like customers could hold money on the exchange or something. Give us a quick 900. Okay, dude, I'll do it. I will do it.
Diabolical. So Sam creates $8 billion worth of air token with SRM and FTT. Then he issues himself locked token, secret locked token, marks it up on his balance sheet by another $4 to $8 billion and calls it $16 billion worth of collateral. Okay. Then he goes shopping for a bank to give him a loan against this. Well, if I took $1 billion of Apple stock and I went to a legit bank, Bank of America, JP Morgan, Goldman Sachs, I say I got $1 billion of Apple stock, they would say, well, we will give you collateral value for up to the amount you have or 5% of the daily trading liquidity on a legitimate regulated exchange. So if you show me a security that trades $1 billion a day and you have $1 billion of it, I might give you $50 million of collateral value. And that means you could borrow $25 million against it at 50% loan to value, but I'm going to margin call you if it moves a tick. So it means, practically speaking, $1 billion of that legit security is probably going to give you $10 million worth of a loan.
On $1 billion.
On $1 billion.
That's 1%.
Okay, right? Because the gating factor is what's 5% of the trading liquidity of that token or that asset? Because if I have to dump that thing in the market, I want to sell the entire position without moving the price.
Sure.
Okay, so that's the traditional world onshore. What Sam did was generated $14 to $16 billion worth of Solana, FTT, Serum, and then he went shopping for a bank to give him a loan. But he didn't want, you wouldn't get a loan from Goldman Sachs on it. No one's going to borrow you money, at least no non-crypto company. So what he did was he went to himself. He runs a bank called FTX. He applied for a loan from himself. He granted himself the loan.
For a loan from himself.
Well,
right?
secretly applied. He didn't tell anybody, but when they say, well, Alameda had a margin account and the margin position was slightly bigger than I thought, what he means is, they pledged a few $1 billion of air token, gave themselves a $10 billion loan, and they extracted, even if he had pledged $15 billion worth of air token, giving yourself a $10 billion loan means that you gave yourself about 100x the collateral value you would have got on a regulated exchange onshore. So what he did was, in essence, extract $10 billion of real stuff, dollars, Bitcoin, saleable assets, and he pledged $10 billion worth of air token stuff. And of course, it's a double diabolical thing. Here's the problem. So I create a token, I have 300 million tokens, and then I basically trade it with myself. Like I give it to you and you work for me and you give it back to me. Then I lean on it, so I lever it up 10 to 1. On FTX, you could lever it 20 to 1. Then I borrow your money, you're a depositor, so I take your money, you have $10 million, I lever it up 20 to 1, I have $200 million, I buy my own token, I drive my token up by $5, $5 times 300 million makes me 1.5 billion in collateral. I post the collateral, and then I withdraw $1 billion of 100,000 people's money. I put it in Alameda, and then Alameda gives a $3.5 billion loan to Sam, right? He gave $3.3 billion to either himself or his personal family holding company. So here's the diabolical twist. I didn't just generate $10 billion of an unregistered security to dump it on the unsuspecting retail. That would take me 500 trading days, dumping 20 million a day, right? He didn't do that. What he did is he generated $10 billion in unregistered security and then just borrowed $10 billion secretly from his depositors and then went and gambled it, traded it, spent it, lost it. And,
how?
And that is it's particularly impressive.
How do you, so here's the question. You know how he goes and he raises the $2 billion, okay? And he gets the $2 billion from not small people. He gets it from the best of the best of the best, right? You got BlackRock, you got Insight. You know the names. I don't need to give you the names. You know the names. So
major names, right?
Then they don't get any seats, board seats in return. These are very, very smart people who are seeing this. Are they just as responsible for the fall of FTX as Sam Bankman-Fried is?
The Bitcoin maximalist would say that the problem in crypto is greed, arrogance, and foolishness. Okay, anybody that's investing in it is either greedy, arrogant, or foolish. So
True.
There's three constituencies that got taken for billions of dollars here. The VC investors put $2 billion into an offshore exchange. The exchange, just to be clear, was unethical and illegal from the very beginning. It's illegal to do what they did in the U.S., and it's unethical if you think I am front-running my customers, issuing a token, manipulating the price of the token, dumping it on them.
If you did that in stocks, you're going to jail if you front-run. It's not.
It's absolutely illegal.
Yeah.
Right? FTX was its own regulator, its own market maker, its own exchange, the issuer, right? All at the same time. This is such a and the hedge fund. Too much conflict of interest. So, but the three constituencies are the VC that put the $2 billion into FTX. They were supporting basically an offshore, unregulated casino, running in opaque fashion, a counter the interest of its own customers. They didn't ask for a board seat. They didn't do due diligence. They were chasing what they thought was insane gains, right? FTX is showing a company that goes from 50 million in revenue to 500 million in revenue to $1 billion in revenue, and they thought they just had the next great thing. So, Sam lies that any con, right, is like, I think I'm getting a deal that's too good to be true, and the con man is lying to me. We're all lying to each other, and so that's the first $2 billion goes down the drain.
How mad do you think Athena is that he couldn't get in on one of these really good crypto scams?
There's another $4 billion or something like that in just loans made by crypto industry. I think Alameda borrowed hundreds of millions and billions of dollars from Genesis, from Three Arrows, from Voyager, from Celsius, from BlockFi, etc. So it's like if you start with this fiction that FTT is a real thing. If I create, again, like yo-yo token, and I manipulate the price up to $10 billion by trading 2% of the float, if you think it's a real thing and I act like it's a real thing, then I pledge it as collateral and you give me real stuff for an air thing. And so there's like $4 billion of that, and they went and they lost half of that. That was part of the reason that Voyager and BlockFi going bankrupt. And the reason that Sam wanted to bail them out is he didn't want to actually have the loans called, right? He was actually trying to buy BlockFi and buy Voyager with FTX equity, which of course is fraudulent and worth nothing. But if I borrowed $1 billion from a company and they want the money back, and I can simply give them $1 billion of equity, take over the company, and not pay the loan back, I can roll the entire fraud forward. So that's the second. The third is, this is also diabolical. FTX said, we're built by traders for traders, and Sam bragged that they only charge like 3 basis points trading fee, and he was 30 times cheaper than Coinbase or much cheaper than Binance. So he's stealing customers off of the other crypto exchanges by, in essence, offering near free trading. He's not trying to make money off the trading. He's trying to actually get the assets on his platform, because once he had the assets on his...
Oh, shit. That's super true. Because once he has the assets on his platform, he can use that as secured collateral to fund his other investments or his other business ventures, right?
His platform, he basically used FTX like his own personal piggy bank.
Yeah.
It's like there's $10 billion there. Everybody else is going to get wiped out if...
So, of course, he's offering favorable terms is because it's a fucking scam. And that is true. Yeah, you're stealing from other exchanges to do it. Yikes.
If their margin positions trade down 20% for a minute, except Alameda. Alameda has God mode. They never get margin called. So in an exchange, like in the U.S., it's illegal to go more than 50% loan to value. That means you're kind of like, you start with $1 million, you borrow $500,000, you're 1.5x levered. Okay, well, FTX started with 100x leverage, and then they backed it down to the responsible 20x leverage, which means that you post $1 million and you can take a $20 million
insane. Okay. Who allows that?
Now, here's the insane. What if I put $1 billion of air token, FTT, on the exchange? I recognize you, and I let you take a $10 billion bet. Like, whatever, you took a $10 billion bet, now you withdraw $4 billion of real cash, and you use that to buy property and buy everything under the sun. So Sam basically, he scraped billions from unsuspecting investors in Silicon Valley. They should have known better. He took billions from crypto hedge funds and crypto banks like BlockFi and Voyager. They should have known better. And then he took probably 10 billion or more from depositors on his exchange. They have the best argument. It's like they were staring at terms and conditions that said he's not going to rehypothecate or use their assets.
Yeah.
And he just, he lured them with the promise of cheap trading, high leverage. And, if you thought, well, Sam is manipulating the price of FTT and Serum and Solana, and he was, right? That's illegal and unethical, right? It's a pump and dump scheme. We talked about this before. But if you accept the idea,
unless you could prove that the investments made using deposits to back were safe, then you have no argument. You're not supposed to be investing those funds, my dude. I know that you're the other guy on the other account. I can't tell if you're a massive troll or not, or if you're just really stupid. You just can't do that. You're not supposed to use those funds to invest, my dude.
The crypto tokens that are issued by some offshore, dude are okay. Then you're thinking, well, I guess I want to go buy some of that and get behind Sam and Alameda because they're going to drive the price up. And I think Solana went from, $3 to, what did it go to 50? It went way up, and FTT went to $50 a token or something. So you could have made a lot of money trading those tokens, but you probably would have wanted to go to the FTX exchange because, guess what? Newsflash. It's illegal in the U.S.
Order your Future Looks Bright hat. Click over here, and to watch the entire...
Wow, based.